Welcome to Illuminati Silver. We tell you the truth about silver. Today is Saturday the 11th of April 2020, and earlier today we published our gold and silver weekly update for the weekend in the 10th of April. And if you haven't had an opportunity to listen to that, then we've provided a link in the description box below. Now, this evening we thought we would address an issue covered by a number of our subscribers, basically claiming that equity markets were due not just for a fall, but a collapse. And all that it needed was one catalyst in order to engineer such a decline. Well, to some extent that has been shown to be correct, at least to a certain level. And we thought that we would offer one investment manager's view of where the markets currently lay and why they really fell in the first place. His name is Dan Kemp. So let's listen to an article he has recently published in this week's Financial Advisor magazine, a publication specifically for investment advisors. Article by Dan Kemp, Chief Investment Officer, EMEA, Morningstar Investment Management, Europe. A few months ago, investors were likely smiling. Major equity markets made a strong start to the new decade, with US equities up more than 10%. Continuing a bull market run that started more than a decade before. But now, in a striking volte-face, the tide has turned as investors adapt to the current risk-off environment. The change in sentiment is generally attributed to the economic impact of COVID-19. So, to what extent did this expose existing market weakness rather than perhaps cause it? Market pundits quickly and easily offer explanations for each day's rout. But what is often left unsaid is that these are suppositions, if we are being polite, guesses if not. No time is given for research and testing. No time is available given the short deadlines of not just daily press, but the instant online press. In this realm, plausibility carries considerable weight. So it is with some trepidation and considerable humility that I suggest a cause for market downturns that does not get as much airtime as each day's explanation. That cause is valuation and concomitantly mean reversion. Mean reversion is the concept that asset valuations tend towards a long-term mean or average. When market valuation measures get very stretched, the snapback can often shoot right past the centre and into stretched territory on the other side. We've seen this in individual securities like stocks, as well as in sectors and entire markets. And I believe we've seen that lately in major stock markets around the world, as well as in bond markets too. Whenever you see near zero or negative interest rates, you can bet the market has moved into a stretched position. These situations create opportunities for fundamental investors, those that take the time to estimate an asset's fair value and believe it matters. Underpriced assets tend to outperform as they become fully priced, while overpriced ones tend to underperform as they fall back to fair value. That is, they both tend to revert to the mean. In the short run, these movements are never predictable. That is, one can never say overpriced asset A will decline by X% on Thursday, or even within the next month or year. But we can talk about these things probabilistically. Asset A appears overpriced, so we do not like its prospects over the next market cycle of about a decade's time. In order to access these opportunities, investors must have a process for comparing the potential reward for risk profile of one asset to another, as well as evaluate an asset's attractiveness across time. Such a framework cannot be built swiftly in response to a crisis, but must be established in advance. Those lacking such a framework are naturally less able to take a longer-term perspective and are more tempted to make near-term predictions of market movements. Leading up to recent market collapse, we had believed for some time that many stock markets had growth overpriced. None as much as the US market. Prices of US stocks made sense to us only in the rosiest of all possible worlds. That does not mean we predicted the decline, only that we expected future US stock performance to be much weaker than its performance of the recent past. The S&P 500 notched a 31.5% increase in 2019. The market probably did not need much to spook it out of its belief in US stocks. Yes, the US economy was stable, and investors seemed confident. The S&P 500 had risen more than 10% in early 2020 before it began its long fall. But I do not believe that the market bulls were fully considering valuations. As prices become increasingly detached from a reasonable assessment of the fair value of an asset, the probability of a significant fall increases, and consequently the more vulnerable prices become to any period of economic weakness. We did not get minor economic data, but a rare massive upset to the global economy. And arguably we got two of them: the virus and the oil sell-off. That said, the former came in like a lamb. Recall that in the early days, no one was predicting we would all be stuck at home, unable to meet with friends, go to work, or spend holidays abroad. Some investors sold out early, but for most it was a minor concern. Then came a dispute between two of the world's largest oil producers that sent the price of crude tumbling, bringing stocks down with it. The fact that markets fell before the oil dispute suggests that early news was enough to blur the rosy picture investors were relying on to support high valuations. Looking at two stock markets through the valuation lens, I think we will find some cause to believe that what has happened recently exposed market weakness in the form of overpricing, which led to selling, which in turn drove down all global markets. Going into the market downturn, UK stocks offered one of the best valuation-based opportunities among world markets, developed or emerging. Large UK companies are multinationals deriving considerable revenue outside the United Kingdom, yet the overall market was not immune to fears surrounding Brexit. Prices were low relative to the strength of underlying cash flows, or so we reasoned. In contrast, the US market was among the most overpriced of mainstream investments, in our opinion. Driven largely by the high-flying tech names like Microsoft, Apple, Amazon, Alphabet, Google, Facebook and Netflix, seemed permanently buttressed by sentiment. Belief almost that these company stocks could move in only one direction: up. Of course, that belief is not true, and one need only look back to the fourth quarter of 2018, when the US market declined, peak to trough, more than 19%, to see evidence of the fragility of this market. A fragility, we would argue, created by overpriced stocks. That US stocks were overpriced was not a secret. So I believe, and this is of course unprovable, that the growing fear about how COVID-19 might affect stocks got an early flip from the knowledge that US stocks were already dear. Their high price gave them more room to fall, and the more they fell, the more global sentiment worsened. Investors did not differentiate between reasonably priced markets like the UK and overpriced ones. Thus, overpricing led to repricing, which dented sentiment, which led to selling and worsening sentiment. Later, stocks continued to tumble as the impact on economic activity came into sharper focus. For example, a weekly unemployment figure in March in the United States was nearly 5 times its previous worst record level, as thousands of companies were crippled by stay-at-home orders. Markets are now extrapolating. They are pricing in today's shut-in economy well into the future, when again we expect to see reversion to the mean. As low as downturns go, they always seem to find a way back. If you group stock markets based on valuation, that is, price relative to fundamentals, you will find that underpriced stocks tend to outperform overpriced stocks in the long term. We believe this is a key tenet for investing. It is at the core of our investment process, and we believe it should be a financial advisor's North Star, even if they hire someone else to build portfolios for their clients. Letting valuation drive asset allocation forces you to study fundamentals. And understanding that underpriced assets outperform in the long term empowers you to act like a long-term investor. Market declines are no longer marked with short-term fear, but long-term opportunity. This is a key change in mindset, as perhaps the most dangerous parts of downturns are psychological. Fear of further losses can cause an investor to sell out, thereby locking in losses, as it is unlikely they will get back into the market in time to catch the rebound. We have begun to take on not less risk but more as prices have fallen and the risk-reward picture improves. We still view UK equities as being attractively priced, and US stocks are much more attractive too. We like European financials and global energy, as these companies have been hit particularly hard in the sell-off. Again, we like these assets because we believe their price will come back, and they have further to come back than assets like technology and healthcare companies in the United States, which have held up much better in this down market. Being a valuation-driven investor makes you a bit of a contrarian. We try to be, as business magnate Warren Buffett once aptly put it, greedy when others are fearful, and fearful when others are greedy. After a long period of being fearful, a silver lining of this crisis is that we can now eagerly look to markets for bargains. End of article. So, in essence, Dan is stating that it's all about value, and whenever a stock or share moves out of the value spectrum, it will eventually revert back to the mean. Let us know if you agree with him or not. Thank you so much for listening. If you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they're published. Not forgetting that we update our Richard and Greg channel every other day, and so if you haven't done so, please subscribe to that one too, and likewise press the bell sign there. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.